Thank you for watching this lecture. Today we're going to cover capital budgeting in engineering economics. Now, capital budgeting and engineering economics are required whenever a company must spend a large amount of money for a project. Why do they do this? Why do they do capital budgeting? To make sure that the project is going to be profitable. And the company wants to make certain that the money that they're going to spend is worth it. When do you do engineering economics? This is done in the planning stage of a project before the project is started. Engineering economics is a screening technique. It's a feasibility study to assess if the project is profitable. Engineering economics and capital budgeting are required to be done by a corporation. The corporate charter requires a company to perform engineering economics and capital budgeting before a major project is started. Engineering economics and capital budgeting are best practices in every successful business. A study showed that every large business does the techniques that we're going to be looking at in the upcoming lecture. Now, every business has their own variation of these techniques that applies best to their business. We're only going to focus on the most fundamental techniques that apply to every business. But if you work in an industry or a business where you have to perform capital budgeting, it's important that you learn the techniques that your company is going to use. But the fundamental techniques that we're going to do today apply to every business. Engineering economics and capital budgeting, these terms mean the same thing. They use engineering economics in engineering school, while business school uses capital budgeting, but they mean the same thing. And I'm going to use these terms interchangeably, so please be aware of that. Now, what are some examples of projects? I have just a short list here that I made up myself, but this is replace the office copy machine, purchase a new fleet of trucks. Do you lease or buy a building? Do you open up a new branch? Do you merge or do you require another company? So I'm starting off with very small, the office copy machine, versus merging or acquisition, which could involve billions of dollars. There are many different examples of engineering economics, but this is just a short list, and hopefully give you an idea of what is involved when you're dealing with capital budgeting and engineering economics. Engineering economics and capital budgeting are done during the planning stage of a project, and they're done in conjunction with other feasibility studies. What are some feasibility studies that companies do? Requirements analysis. Engineering economics is part of this. Systems analysis and control. Functional analysis and allocation. Design synthesis and verification. So these are many feasibility studies. We won't cover these at all, except for the capital budgeting. Now, what makes a project profitable, right? The economics of a project are based on an increase in revenue, a decrease in expenses, or any cost savings generated, or a combination of these two. It's easy to understand how an increase in revenues is going to make a project more valuable. Anything that increases revenues is valuable to a company. However, how do cost savings increase the profitability of a project? Let's assume that the revenues remain the same. If the expenses decrease, net income will increase. Think about fuel-efficient cars, energy-efficient appliances. All of those aren't going to increase revenues, but why do you purchase those types of equipment? Because of the cost savings associated with them. So just think how you feel when gasoline prices go down. It's the same effect. That's the effect that cost savings bring to a project. Many of these projects will require a large upfront dollar expenditures that will not generate any additional revenues. So why do you purchase these type of projects? These projects make economic sense because of the cost savings or the decreases in expenses that they generate. So don't discount these cost savings. They're very important to a project. Many times, a project is economic because of the cost savings that the project gives to the company. Now, all the figures that we're going to look at when we do engineering economics and capital budgeting are estimates. Remember that we're doing feasibility studies before a project is started. Now, these projects are expensive. There's a lot of money that's involved. So we want to use a variety of techniques. Why? It will deal with the uncertainty of these estimates because, again, these are estimates. We don't know with certainty what these dollar amounts will be. We want to look at the project from every angle possible. We want to look at the project upside down, forward and backwards, left to right, right to left, to make sure that this money is well spent and the profits from this project really are feasible. We want to leave no one stone unturned. We want to make sure, because we have to spend a lot of money to make sure that this project is going to work. So these are the project cash flows that are associated with the project. We have the initial outlay, the after-tax cash flows, and the terminal value. So I'll go over these in much more detail coming up. But below you see a timeline that indicates the timing of these project cash flows. The initial outlay, let's assume that we have a project that will last for 3 years. The initial outlay will occur today. Year 1, year 2, year 3, these are the after-tax cash flows that are generated by the project. And finally, in year 3, this is the terminal value. These are cash flows that occur when the project is completed. Let's look at initial outlay. What is initial outlay? Initial outlay are any cash flows at the beginning of a project. The initial outlay will always be a negative number. At a minimum, the project should generate enough cash inflows to recover the initial outlay. This is a break-even concept. And ideally, the project would generate cash inflows well beyond the initial outlay. You don't want to just recover the initial outlay, you want to make profits beyond the initial outlay. Initial outlays are any expenditures necessary to get the project up and running, including the cost of the equipment, the transportation in, installation of the equipment, training. You need to combine all of these if any of these are involved, and this will be the initial outlay for a company. So these could be significant. Basically, this is what you're chasing. Will your project have project cash flows that cover the initial outlay? The next project cash flow that we want to focus on are after-tax cash flows. So after-tax cash flows are generated by project operations. These are cash flows generated by the project, and these are similar to cash flows from operating activities from the statement of cash flows. Your after-tax cash flows may be negative But in the long run, they have to be positive for the project to be profitable and for the economics of the project to work out. Your after-tax cash flows are calculated by adding the cost savings and the revenue increases from the project operation. The after-tax cash flows must be calculated for many years for the life of the project. So if the project has a 20-year life, you must estimate 20 years of after-tax cash flows. Each year of the project must have an after-tax cash flow. Terminal value. Terminal value are cash flows unique to the end of the project. Your terminal values only occur when the project is finished. They only occur at the end of the project. Your terminal value can be broken into two component parts: salvage value, which is a cash inflow, and cost of removal, which is a cash outflow. Your terminal value may be a combination of salvage value and cost of removal. Salvage value, which is a cash inflow, may include scrap metal, any trade-in value for an old car, an old truck, old equipment, wood and paper products used in recycling, anything else associated with that. What does cost of removal include? Your cost of removal is a cash outflow. They may include removal of hazardous materials, building demolition, etc. What are the evaluation techniques that we are going to discuss today? The net present value, the profitability index, the internal rate of return, and the payback period. Again, there are many other techniques, and companies use techniques that are unique to that company. But these are the four foundation techniques. These are the four techniques that are the parent to other techniques that companies may modify. It's not a choice. Whenever you perform engineering economics or capital budgeting, you need to use all the techniques that we're going to introduce today. It's financially prudent to use all four of these techniques. And earlier we had talked about these techniques in the corporate charter. Companies are required to perform these four techniques when there's a large capital expenditures. This is a fiscal responsibility that must be completed. Let's start then with net present value. What is net present value? This is the value of a business is increased by the net present value generated by a project. This method is the best method from a theoretical standpoint. Your decision whether to accept or reject a project using net present value should be consistent with another evaluation technique, the profitability index. With the net present value, the higher the better. You want the net present value for the project to be as high as possible. The net present value that you calculate should be a dollar amount. If the net present value is positive, the project should be accepted. So you perform your analysis and you calculate a net present value of $100,000. You should accept the project. However, if the net present value is negative, the project should be rejected. You perform your analysis and the net present value that you calculate is negative $50,000. in that situation, you should reject the project. So here's the formula for the net present value. Let me leave that up there for a second so that you can copy it. ATCF is after-tax cash flow. TV is terminal value. IO is initial outlay. I is the interest rate that you're going to use in this analysis. T is the time in years. And N is the final year of the project. The next evaluation technique, the second evaluation technique, is the profitability index. The profitability index measures how efficiently a project generates net present value. The profitability index is a relative index number that fairly compares projects of different magnitudes. So what if you have one project that's worth $100,000 and another of $2 billion? Your profitability index will tell you which one is more efficient in generating net present value, even though there's a big difference in the magnitude of those expenditures. Now, the decision whether to accept or reject a project using the profitability index should be consistent with the net present value decision. With your profitability index, the higher the better also. The profitability index should be an index number. If the profitability index is greater than 1, the project should be accepted. However, if the profitability index is less than 1, the project should be rejected. The profitability index is a secondary calculation. You need to calculate the net present value first, then calculate the profitability index. So the net present value calculation is an input into the profitability index calculation. So here's the formula to calculate the profitability index. In the numerator, you have the net present value plus the absolute value of the initial outlay. And all of this is divided by the absolute value of the initial outlay. Let's talk about the consistency between the net present value and profitability index. The profitability index and the net present value should give consistent acceptance, rejection decisions. Both the profitability index and the net present value should both say to accept the project, or the profitability index and the net present value should both say to reject the project. If the decisions don't agree, you did something wrong in the calculations. If the net present value says to accept the project, while the profitability index says to reject the project, you did something incorrectly. They both have to say accept, or they both have to say reject. So this is an important way to go out there to check your work. The third evaluation technique that we want to discuss is the internal rate of return. So the internal rate of return is the return on investment that we receive from investing in the project. The results from the internal rate of return are intuitive, they're easy to understand and relate to. So when you're discussing the economics of the project, it's a good practice to begin with the internal rate of return. What if a project was only going to return 2%? Not very exciting. But what if a project was going to return 20%? obviously that sounds like a good investment. Okay, so the internal rate of return is something that most people can relate to. Now, the calculation for the internal rate of return is very difficult. However, nowadays, with computers and financial calculators, it's a very simple calculation. With your internal rate of return, the higher the better. The internal rate of return should be a negative number. If the internal rate of return is greater than the net present value interest rate, the project should be accepted. If the internal rate of return is less than the net present value interest rate, the project should be rejected. The internal rate of return is the interest rate that makes the net present value calculation equal to 0. So let's try an example with the internal rate of return. The net present value has an interest rate of 10%. This is the borrowing rate that the company must incur. You do the internal rate of return calculation. If the internal rate of return is 12%, you accept the project. What does this mean? The company borrows at 10%, and the project returns 12%. If the internal rate of return calculation is 7%, you reject the project. This means that the company borrows at 10%, but the project only returns 7%. That doesn't make sense. The project has to return at least 10%. If the project only returns 7%, this project is unprofitable. So here's the formula for the internal rate of return calculation. So it's somewhat complicated, but we'll show you a little bit later how to do this on the computer. And again, what is the internal rate of return? That's the interest rate that makes the net present